So the topic for today's video is how do we decide whether a stock is halal or not? Now, I think I have covered this topic quite extensively in the past, but because this is something that keeps coming up again and again, so let's do it one more time. So, stock, as you know, is basically an ownership certificate in a company, right? Shareholders or stockholders collectively own a company. If you buy a stock, so you become basically a part owner of the company, depending on how many outstanding shares there are of that company. So if the outstanding shares or the total share in a company is 10 and you hold one of those shares, then you own 10% of the company, right? And if you own more than 51% of total shares, then you have the controlling stake in the company. So from an Islamic point of view, to buy businesses and to be part owner of a business is permissible. Therefore, a stock, by its very fundamental nature, which is ownership in a business, is permissible, given that the business itself is something which is permissible in Islamic law. Now, so therefore, how do we decide whether a stock is halal or not? Now, there are many different Sharia boards in the world, different Sharia scholars who have different opinions. On one extreme end, there are people who still believe that investing in stocks is completely impermissible, and they cite other reasons as well. Mainly, one of those is that the concept of limited liability is something which is questionable in their opinion. I don't think that is problematic from an Islamic point of view, but that is an interesting topic to dive into, and inshallah, we'll do that in later videos. But right now, most Islamic scholars, most Sunni mainstream scholars, uh, do not have an issue with the concept of limited liability. Hence, whether a stock is halal or not basically boils down to other factors, which is the permissibility of the business itself and the financial ratios, the financial structuring of the company, and the income of the company. Where is the income coming from? How pure is that? So let's just go through that one by one. The first screen is the business screen. So the business should be something which is permissible, such as making furnitures or IT consulting, tech companies, pharmaceutical companies in general, textile companies, construction companies, commodity companies like involved in metallurgy of, let's say, zinc and iron and copper, uh, trading companies like the companies who do import and export. So, like, these are just some of the things which are coming to my mind at the moment, and these are obviously permissible. And on the other hand, there are certain categories which are obviously not permissible. The first of which will be conventional finance institutions like banks, insurance companies, uh, NBFCs, credit financing companies, buy now, pay later sort of companies. Those kind of companies will not be permissible and they'll be screened out in the initial stage, in the initial filter. Uh, but once we do know that a company's primary business is something which is compliant or not specifically problematic, then we go on and do the income screening. Now, this is where there is a lot of different opinions of different scholars. The largest Islamic finance body in the world is AOFI, Accounting and Auditing Organization for Islamic Financial Institutions, based in Bahrain, which is the largest body of Islamic scholars from all around the world. It's a non-profit, non-government organization, and they issue general guidelines with regards to Islamic banking and finance, including the capital markets. So the guideline that they have issued is that not more than 5% of the revenue should be from impermissible sources. Now, what exactly is the rationale behind this 5% is a separate discussion in itself, but just to keep this video short, I let you know that 5% is the accepted standard in the industry as of now. Uh, but there are some companies which go beyond 5%. Like, I think in Saudi and in UAE, they go up till 10%, which is obviously wrong. Uh, but in India, Tasis, many of you might know about Tasis, so they have sort of reduced 5% tolerance to 3%. simply because that even if we make it as restrictive as simply 3% of non-permissible income as opposed to the entire revenue, so 3% non-permissible income divided by the entire revenue should be 3% or less, uh, as opposed to 5% limit, which is usually imposed. So this is obviously a more conservative criteria, which is closer to the true spirit of Islamic finance, which is that there should be no permissible income, no impermissible income at all. So that should be zero. But since making it zero will make investing extremely restrictive, and investment in the stock market is for most people the only viable avenue for investment. So this is a little bit of tolerance that we have. So we at Ethica Invest, we also do follow the 3% impermissible income tolerance. So how do we arrive at that? So we have a compliance team. Right now, it's just one person, and so what our compliance analyst does is she basically goes to each and every company's official website and downloads the latest financial data available, which all public companies are required to publish every quarter, every year. The annual reports and the quarterly reports, and then we basically see manually. We check every company manually as to what their source of revenue is, where is all the revenue coming from, and then we put all the numbers together and we make sure that not more than 3% of revenue is from non-permissible sources. And you can check this data on ethicainvest.in. Uh, then once the stock passes this criteria, then the next is the debt levels. So the debt of the company, the interest bearing debt of the company, should be less than 33% of total assets. A lot of companies follow market cap, which is a more liberal approach, but we take total assets. I think it's a more solid, a more substantial approach, and it kind of does away with the volatility of compliance status. And the final compliance criteria is liquidity. So the liquidity should not be more than 90% of total assets. That is to say that the company should have at least some degree of hard assets. Otherwise, if it's simply cash or liquid assets, then trading stocks would be something like trading cash, which is impermissible because obviously it leads to riba. So these are the criteria, right? The business should be permissible. That's the first thing. The non-permissible income should be less than 3% of the revenue. The debt should be less than 33% of total assets. Liquidity should be less than 90% of total assets. That is the criteria that we use at Ethica Invest to decide whether a stock is halal or not. And even after this, at the end of the year, you're supposed to purify your investment. So whatever capital gains and dividends you receive, you should give away a certain percentage of that in charity, depending on what is the non-permissible income. So for example, if the non-permissible income is 1%, so you should give away 1% of your capital gain from that stock to charity, and 1% of dividend from that company to charity. So I hope that cleared up the question, what is halal stock and how we at Ethica Invest screen for halal stocks. And you can go to ethicainvest.in and see for yourself all the numbers behind the compliance status of a stock. Assalamu alaikum.